Fitbit will report results after the close today, and one of the main things we'll be looking for is the success of the pre-sales for the Fitbit Alta, which was released earlier this quarter. And we know it's not going on sale in the retail outlets until next month, but the pre-sale orders will give a good indication of how this product will be received by the market. And the reason we're so interested in the Alta is because it retails for $129 and has a number of pretty expensive accessories that go along with it. So we think this will actually do a good job of pulling up the average selling price per unit. So in this video, we're going to prepare for tonight's release by taking a look at the guidance management gave us on the last earnings call. We're going to plug that into our earnings model and see if the consensus estimates are in line with management's guidance heading into this call. If you'd like to download this model, it's available for free on our website, gutenbergresearch.com. You can click on the Free Models Download tab, and from there, if you scroll down to Fitbit, you can just click this button and you'll see it pops right up. So let's take a look at this guidance. Rather than switching back and forth between the two windows, we'll just take a quick look and see what they have here. So revenue in the range of 620 to 650, gross margin on a non-GAAP basis between 48 and 49%, adjusted EBITDA between 80 and 100 million, and non-GAAP diluted EPS of 20 cents to 25 cents, and that's based on non-GAAP shares of 253 to 255 million, which is an increase because of that additional offering they had last quarter. Stock-based comp between 18 and 20 million, and a non-GAAP tax rate of approximately 33%. So now let's take a look at our model, and I'm just going to blow this up so it's easier to see. And for each of those items, I know we ran through them quickly, but they're in the comments section here. So you can see management guided revenue between 620 and 650 million. Here's the share count, 253 to 255. And in general, the purple cells represent guidance. Non-GAAP gross margin between 48 and 49%. Non-GAAP tax rate, 33%. Stock-based compensation between 18 and 20 million. And then finally, adjusted EBITDA between 80 and 100 million. So just so you can see how this model works, we model the income statement on a GAAP and non-GAAP basis. Below that, we have segment details. The breakdown between region is just done based on prior quarter's percentage of each region's sales. And the sales are generated by using a unit growth rate and applying it to last quarter. So you can see we have a 49% growth rate for the fourth quarter, which is consistent with historic results. Just expand here to see history. And you can see there was a huge increase as they were ramping their products in the fourth quarter. I think that'll be a little bit more muted this quarter. And then to get to revenue, we take the total units sold and we multiply it by an average selling price per unit. And we know that there's accessories and other things that go into the total revenue line. So this is really more like saying average revenue per unit sold. And then when you multiply those two together, you get the top line revenue estimate. So then we can just work our way down the income statement here. You can see that our revenue, based on the growth rates in ASP that we put into the model, gets us to revenue of $648 million or so, which is the high end of management's range. On the gross profit front, we entered a gross margin that on a non-GAAP basis, which was right in between management's guided range, so 48.5%. Then for R&D, sales and marketing, and general and administrative expense, the three operating expense items, we kept those ratios as a percentage of total revenue somewhat consistent with past results. And keep in mind that this is still a new ramping company, so these ratios tend to fluctuate quite a bit. But we have seen the R&D and general and administrative come down quite a bit in the fourth quarter, as there's a larger revenue base in the fourth quarter with the holiday sales. This year we actually decided to tweak the sales and marketing expense downward somewhat, and part of that was just to get into that adjusted EBITDA range that management guided. So that gets us to the operating income line in the income statement on a GAAP basis, and then we have some non-GAAP adjustments. So let's take a look at what we're doing there. Scroll back over to this quarter. So down here you can see our non-GAAP adjustment summary, and the majority of that is just stock-based compensation, so nothing really too fancy. Stock-based compensation and intangible assets amortization, which is pretty consistent with all the other tech companies that we cover. And there is also a bit of OPEX adjustment for the Fitbit Force recall, and they do have a section in their 10K and 10Q which describes why they recalled and how long that'll last. It's really not that significant, so you can see in the next couple of quarters we actually take it out. But if it does become significant again at some point, we would make the necessary adjustments. And then after that, we have a tax impact adjustment on the non-GAAP items. So the main one to look at, this $19 million, is stock-based comp. And like we said in the beginning, the management guided their range between 18 and 20 million, so we're at the midpoint of that range. So that gets us to our non-GAAP adjustments. So now we're down to the operating income on a non-GAAP basis. Then we just have some interest expense and other income. Again, not too significant. Provisions for income tax, they gave guidance there, and that gets us to our non-GAAP and GAAP net income. So there's just one other thing we should talk about, and that's the adjusted EBITDA, since that's how management measures their performance. So you can see we take our net income on a GAAP basis, and then we have our non-GAAP adjustments. We add back depreciation and amortization and interest expense and income tax, and that gets us to our total adjusted EBITDA. So we are now at 92.8 million, which is about the midpoint of management's guided range, a little bit ahead of the midpoint. And that brings us down to our diluted share count, which we set to the midpoint of management's guided range of 253 to 255 million. And our non-GAAP EPS of 25 cents, which is the high end of management's range and in line with consensus estimates. So overall, we could say that given the guidance that management gave last quarter, the street is in line with that guidance, although it's at the top end of that range. So now let's do a quick look at what we're doing for valuation. So our Fitbit model is a tier 2 model, which means our focus is really on the modeling of earnings. We're not doing a discounted cash flow valuation. We're simply doing a price earnings based valuation, and this is using the next 12-month consensus EPS estimate to develop the PE ratio. So heading into this release, shares are trading at near lows of on a PE basis. So it's trading at 13 times the consensus next 12-month EPS estimate on an ex-cash basis. So about 15.50 heading into this release, depending on where it closes today. So based on that valuation, we're in line, but keep in mind this is the low end of that total average. So the average over the last 3 months was 21 times. So obviously if you changed this multiple to 21 times, you're looking at a valuation well ahead of $20 a share. And that's closer to what the analysts' expectation is at this point. And that's after analysts have cut their targets over the last 3 months or so. So after the release comes this evening, we can update the fourth quarter results and the new guidance for management. So they're going to give us guidance for the next fiscal year, which is going to be key, obviously. And right away, we'll be able to see what the share impact is. So join us for that after the call. But before we leave, we should take a look at what some sensitivities, or run some sensitivities on the average selling price and the gross margin, just to see what the impact could be on EPS. And we're just going to focus on the fourth quarter at this point. So right now we've got an average selling price of $91 per unit, which is in line with the typical increases we see in the fourth quarter, keeping in mind that we had a higher average selling price last quarter than we did in the third quarter of 2014. And then the gross margin is about 48.5%. Let's see what would happen if we increase that gross margin to be in line with management's high end of their range. So let's increase the non-GAAP gross margin to about 48.7. That gets us just above management's guided range, 49.1% versus 49%. And you can see that added about a penny of EPS. So not a huge deal there, but keep in mind that will have an impact going forward. And some of the things that could change that gross margin, obviously we know that there's going to be some impact from FX. And on last quarter's call, management said that they're taking steps to mitigate some of that risk, but they don't expect it to be fully in the numbers until the back half of 2016. So there could be some significant impact on FX for the first 2 quarters of 2016. And we also know that their sales overseas, especially in Asia, are outpacing the sales in the United States. So the ratio of U.S. sales is going to decrease. And so the FX impact will have a greater impact on total earnings going forward. The other thing that's been a hot topic on the last couple of earnings calls is the fact that the competition in this area is heating up. Obviously, the Apple Watch has been somewhat muted because there are different types of products. But there are other competitors. Garmin has a similar product, and some other ones are emerging. So all of that could have an impact on the average selling price, as well as FX. So if we're not going to reach 85, let's see what the impact would be if we just met the third quarter, which is 85.75. So again, that only had a 1 cent decrease on EPS in the current quarter. Let's see if that impact, how that would translate through the rest of next year. So that would be about $5 decrease each quarter. So 82, 85, 81, we'll call this 86. Of course, I wasn't keeping track there, so let's undo that for a second. So we were at 113 for 2016. Now we're at 107, and shares would drop to about 1472. Also keep in mind that we value cash separately, so the net cash position at the end of 2016, if we had dropped our ASP by those amounts, would be even lower. And also on the lower revenue base, you could expect to lose some operating leverage, so the R&D, sales and marketing, and general administrative as a percentage of total revenue would also increase. So we can undo this. All right, be sure to join us after the call for the updates. Now, before we sign off, I'd like to remind you that our videos, models, and other content are for demonstration purposes only and do not represent investment advice. By viewing, you are deemed to have agreed to our full terms of use, which are available on our website, gutenbergresearch.com. If you're new to our site, please download our free ebook by clicking the thumbnail in the lower left-hand corner of your screen. This goes through our entire approach to financial modeling and equity valuation. We also have a 5-video modeling tutorial series, which you can access by clicking the video in the upper right-hand corner of your screen. And we've included an earnings preview and earnings review video here as well to give you a better idea of what to expect from each type of video. If you're interested in financial modeling, please click the button to subscribe to our YouTube channel. And since we do not always post our review videos to YouTube, please follow us on Facebook using the link in the description section below to stay up to date with all of our model changes. Thanks for watching, and good luck with the rest of earnings season.